their sample market study for Chicago, Illinois. So first we're going to start with the general makeup of the market. So as you can see for submarkets, the CBD is the largest submarket we have by nearly 30,000 rooms compared to all the rest. And then it's followed by DuPage County, and then the North Market. And then the smallest, it's followed by the airport, and the smallest is then the North Market by nearly 3,000 rooms, and then followed by the South and Southeast Market. So for properties and rooms by scale, the largest is the upper upscale chains by nearly 15,000 rooms, but is one of the fewer represented in Chicago by the property count. And then the smallest is the mid-scale, which followed by the luxury chains by 4,000 to 5,000 rooms, and then both of the least represented also are the least number of properties too. So rooms and properties by class. The largest class is the upper upscale class, and it's by nearly 17,000 rooms, which is followed by upscale and then economy. And then the smallest is a luxury class followed by the mid-scale, and both the luxury class and the mid-scale also have the least number of properties. Most of the properties and rooms are located in the suburban area, and then it's also followed by the urban area. And then the least number of properties is in the resort and small town. Okay, then for the size of the rooms and properties, the sizes are well represented through all categories, but the biggest, most represented category is rooms from 75 to 149 rooms, and then it goes followed by the 150 to 299 rooms, and the smallest category for size is the less than 75 rooms, followed by greater than 500 rooms. For chains, so the census there was 4 Hiltons that had above 500 rooms that were represented. And so they have the most chains in Chicago. The next would be the Hyatt Regency, and the Westin are the top 3 of the properties that have over 500 rooms. Then the last property that had over 500 rooms was the Crowne Plaza, but there's only one property in Chicago. This is just a bar graph form of the information to compare. As you can see, the Hilton and Hyatt really don't compare to Westin through the Crowne Plaza. Just some interesting hotels are in Chicago. The largest hotel is the Hyatt Regency. It has 2,019 rooms. And it also has a convention and restaurant, and it was opened in 1974. Second largest is Hilton, the Palmer House Hilton. It has 1,641 rooms. It was opened in 1929. And has convention, restaurant, and a spa. And the third largest is the Hilton Chicago, with 1,544 rooms, opened in 1927 with a convention and a restaurant. The oldest one is the Union League Club of Chicago. It has 190 rooms, so it's really small, but it was opened in June of 1879. And they did renovate a restaurant into it. A top luxury chain is the Fairmont Chicago in Millennium Park. It has 687 rooms and opened in 1987. And the top luxury class chain is the Four Seasons Hotel, and it had 345 rooms and opened in 1989. This is a map of the submarkets and tracts. Chicago West is here, South, DuPage, Downtown, North, and Northwest. And Downtown and North are 2 of the smallest ones, where Southwest and Northwest are the 2 biggest tracts. And here are some attractions that are in the downtown area of Chicago. Even though it's a smaller area, the urban area has the most hotels in it. So you have the airport over here, and then some attractions you might want to go to is the United Center, Magnificent Mile, Art Institute, the Field Museum, and the Observatory, Navy Pier, and things like that.
All right, these are the current statistics for the Chicago hotel market. Right now, Chicago ranks top 5 in hotels, room supply, room demand, and revenue in general. It's also towards the leader of the pack in RevPAR and ADR, and occupancy is more towards the middle. I think it's kind of interesting because looking at Chicago average daily rate, they are not up there in Chicago, and their occupancy is not up there as well, but for as far as revenue, they still make a lot of money, being top 5 in the US. This is a look at the percentage change by year for occupancy, average daily rate, and revenue per available room throughout all of our data from '89 through 2013. If you look closely enough, you notice that during most of the valleys were during recession times during the United States, early '90s, early 2000s, and 2009 being the leader of that. Outside of that, it's about a 0 to 5% growth steadily per year for each category. You could say Chicago is more of a saturated market just because of the amount of hotels it currently has. So having a 0 to 5% steady growth rate is probably ideal for the market. This is breaking it down into the last 10 years alone just to get a better look at it. It's more of a blown up thing. Like I said, you can see looking at 2009 when the recession hit, everything really dropped down as far as people coming into the hotel, money being made, stuff like that. It actually dropped a little bit in the years preceding, heading up to that, but mostly impacted during the recession. It actually dropped below zero 2008, 2009, and rose up from there. This is also a look at the supply and the demand and the actual room revenue. Same thing over the period from 1989 to 2015. It's pretty much the same trend, all the valleys, once again, during recession times in the United States. Peak growth is at a constant, steady 0 to 5, 0 to 10% rate. Supply is pretty much below 0 to 5. It doesn't have very high growth, but demand and revenue, both are about 0 to 5 on average. And this is also a blown up look at the last 10 years. Once again, valleys again, 2009 during the recession, and everything else is 0 to 5%, 0 to 10% steady growth thereafter.
So next we're going to be looking at the trended data. It's really important to look at the trended data to analyze the past and also to predict the future. So for this section we'll be looking at the 12-month moving average from January 1989 through December 2015. Our first graph here shows the relationship between the supply and demand percent change. The most startling part of this graph is the severe downturns that the demand had both in the early 2000s and around 2007, 2009, which, as we talked about earlier, has to do with the economic cycles of the city and the recessions that hit the country as well. It's also equally impressive, though, to see the recovery periods that they had and how quickly this market was able to bounce back and how much the demand changed. Okay, so this graph is showing the actual room supply and demand from '89 to 2015. As you can see, that they both have been steadily increasing since '89, with a few rough patches here and there, both with when the recessions hit. But as you can see, they've also been steadily increasing over the past 5 years. So this graph is looking at the occupancy and ADR percent change. They look very similar to the supply and demand relationship that we were just looking at. It's interesting how the ADR percent change mirrors the occupancy percent change. However, the ADR just seems to be a few months behind what the occupancy percent change is doing. And they also did see the 2 severe downturns, but also 2 strong recoveries. So here is the actual occupancy and ADR. As you can see where we are now, currently at 70%, our previous peak was at 70.5%, so the market is pretty steady right now. Back in '89, you can see how the occupancy was much higher than the ADR, but now ADR is trending much more similarly to the occupancy rate, so the hotels realized that they needed to start charging more for their rooms. Here we have a graph showing the RevPAR percent change and the actual RevPAR. So while both show rocky times, the percent change today is quite similar to what it was in '89, unlike the actual RevPAR, which has jumped roughly from 45 to over 100 in the past 25 years. And here we have the comparison between the demand percent change in Chicago and the demand percent change in the U.S. as a whole. So as you can see, Chicago has trended very similar to the U.S. as a whole, at times peaking and downturning more severely than the U.S. as a whole.
Alright, so next we're going to talk about the economic cycles in Chicago market. My first graph is, as you can see, the average daily rate in the Chicago market is beginning to stabilize within the recent years. You can also see with 12-month data, the peaks and downfalls of the monthly data are averaged out. And the major downturn from the past 16 years was between 2009 and 2011, which was during, as we have discussed multiple times, during the recession. In regards to the supply and demand in the Chicago market, we once again see a downturn in 2009 and 10, as well as 2002, which was after the 9/11 attack, and many were very skeptical about traveling during that time. The supply and demand equate to become the occupancy percent change. Much like the previous graph, we find occupancy multiplied by average daily rate, which is equal to the revenue per available room percent change.
This is the market breakdown for the city of Chicago. This first graph here looks at the supply and demand changes over the last 12 months running data. If you look at it closely enough, luxury is dominating it in terms of supply and demand. The focus is definitely on that right now. Across the rest of the board, the upper upscale and the upper mid-scale category have significant gaps between the supply and the demand. Basically, the city of Chicago needs more hotels in those categories. Looking at the upscale, the mid-scale, and the economy, the supply and demand changes are, the supply outweighs the demand right there. This is the supply percent change for the last 12 months. Once again, luxury dominates with percentages between 5 to 10% each year versus every other category. I'd say upscale has the highest growth of has the next highest growth rather, and the rest of the categories are pretty much between 0 and 1% in supply change every year, except for the economy, which is negative every year, and the back half of the mid-scale. This is the occupancy and ADR percent change for the last 12 months. The occupancy rate stays pretty much the same throughout the whole, no matter which category each hotel is in. It's pretty low, like I said, between 0 to 1, 0 to 2% change for each category. However, the average daily rate has extreme positive change in every category. So not only is just luxury making more money or charging more money per day per room, every category across the whole entire board is. In this graph, you're looking at the occupancy and the average daily rate. The occupancy doesn't change too much from category to category. It's a little bit stronger towards the luxury upper upscale categories and kind of works its way down, but the gap is only a 5% difference between 73% and 68%. All right, this is the running 12-month data for the revenue per available room percent change, as well as the actual revenue per available room. This is kind of a continuation of the last slide in terms of the graph is the same, starting with the economy. It gradually increases as you go up the scale until you get to luxury, where there's a pretty significant gap between the luxury class and the upper upscale class. The actual revenue per available room percent change goes the opposite. So starting with luxury, the percent change per available room has started with 3% and worked its way all the way up to 10% with the economy.
Since 2005, the RevPAR percent changes fall and rise together, as you can see, maintaining a standardized Chicago market. The only exception we have is hitting its all-time low, which is on the next slide, in 2009. And within the recent years, economy revenue per available room percent change is much higher than all of the other classes, which we have seen on the previous slides. All of the other are kind of leveling off or going down, and economy is growing for its supply demand. Okay, and by tract, we see the highest demand is in Southwest Illinois section, as well as higher demand than supply in all other areas. So obviously there's more demand than the hotels can keep up with in Chicago at the current time. The only area even somewhat equivalent is the Chicago CBD, which is almost exactly the same. The Chicago by tract market has overall very strong ADR percent changes, and Southwest Illinois being the only region with strong occupancy percent change, while all the rest of the occupancy percent change are either staying really low or even going negative, as we see in Lake County and the airport. As to not be too surprising, the business district does have the highest actual occupancy and ADR. And in the market, with the airport falling right behind it. And within recent years, we see extremely high actual revenue per available room in comparison to all other tracks. As we have seen in previous slides, the southwest section has increasing percent change in recent years, and it's definitely growing down in southwest Chicago. And finally, while occupancy percent change has not changed much recently in the CBD, the other sections are higher in average daily rate and revenue per available room. Otherwise, we see that the Chicago CBD is dominating the market in Chicago.
Section is going to be about the comparable markets. So this graph shows Chicago versus the top 25 markets based on the number of hotel rooms. So as you can see, Chicago is number 3, tied with New York with 112,000 rooms, behind Orlando and Las Vegas. So this graph shows the Chicago versus other Illinois markets, and so the STR database only provided one other market to compare to Chicago, which was St. Louis, and this graph shows that Chicago exceeds St. Louis in occupancy and ADR. Okay, so this graph shows Chicago and its comparable markets, and the comparable markets were chosen based on proximity, characteristics, and type of business that these markets bring in. And so the graph shows that Chicago's supply and demand growth falls compared to the comparable markets such as New York and Milwaukee and Orlando. This slide shows the occupancy and ADR percent change, and again, Chicago falls in the middle for its ADR, and its occupancy falls on the lower end compared to its comparable markets. This next graph is actual occupancy and ADR, and Chicago's occupancy and ADR actuals are in the top 3, just behind New York and New Orleans. So this graph shows the RevPAR percent change and its actuals, and so again, as you can see on the graph, Chicago's numbers are just a little bit behind New York and New Orleans. All right, we are now going to talk about the types of business that Chicago brings in. So this shows the Chicago weekday and weekend actual occupancy. The graph shows that there's an average of 7% higher occupancy on the weekends. However, the weekday occupancy is also pretty high, almost the same as the weekend, due to transient travelers and Chicago being a transient destination. This next graph is Chicago weekday and weekend actual ADR, and historically weekdays had the higher ADR than the weekend, with 2015 being the highest, and again that's due to the transient travelers. This graph is the Chicago actual occupancy by day of the week, and the graph indicates that there was an increase in occupancy during 2015 for all days of the week, and additionally Saturday has the highest occupancy out of all the years and all days of the week. Okay, this is the actual ADR by day of the week. Monday through Wednesday has the highest ADR during 2015 and 2016, and again, that's due to just transient travelers' businesses, just quick business trips for most people. All right, so this is the Chicago market, the historic occupancy seasonality, and this graph shows that the peak months of the year are May, June, and July, and then there's a slight peak in October, and that's probably just because the weather is a lot nicer in the summer than it is in any other time of the month. And then this is the historic ADR seasonality. And then again, this graph shows that there's a peak in June and October. And then this graph is the Chicago group and transient mix. And basically this graph just shows that while it is a popular tourist destination, it primarily brings in a lot of transient travelers just for short business trips during the week and whatnot. And then this is shows typical differences between group and transient data. It's, as you can see, it's pretty similar throughout all the years during January 2005 and July 2015. And then this slide shows that of the Chicago group and transient demand percent change, and again it shows that transient growth never really declined that much just because business and everything, but group went down in 2009, which was due to the recession. No one was really going on any vacations or whatnot or long trips. And then lastly, this graph shows that the group follows the transient into a downturn again in 2009, which was due to the recession. And there was a prolonged flood effect, but it did recover pretty quickly. And the group pricing was very strong in 2014 and 2015. So here we're going to look at the pipeline data so we can get a better picture of what to expect moving forward in the future for the hotels in Chicago. So here we have the actual room and supply percent change. So these were both taken off of the trended data we looked at earlier. But as you can see, even though supply percent has changed quite a lot over the last 25 years, the actual supply has been on a pretty steady increase. So here is the historic supply growth scale for the last 5 years. There have not been a lot of drastic changes, but you can see that luxury and upper upscale are the only two scales that have not seen any loss in hotels, whereas the other 4 categories have lost hotels, so they've seen closures in those ones. And then here is the same thing, but it's just looking at room numbers instead of number of hotels. So again, luxury and upper upscale have seen the most growth in the room numbers. And then the independent hotels, however, have seen a fairly large decrease in the number of hotel rooms, losing over 2,000 rooms in the last 5 years. Here is a chart of the last 7 hotels to open in Chicago. It's interesting to look at the scales over here because, as we were just saying, luxury and upper upscale have historically been seeing the most increase. But besides for the Curio Collection London House Chicago, that's the only upper upscale. All the other ones are in the other 4 categories. So you can see that they are going to be expecting more growth and have been seeing more growth. So here we are looking at what is in the works, what's in the pipeline. Upper upscale is the most popular scale in Chicago with the most current rooms in existence and also the most rooms in construction at the moment. However, if you also look at the independent hotels, you can see that they're beginning to have an increase in the future with rooms in construction and especially rooms in the planning section. So here is a breakdown of that again, just without the rooms that are currently in existence. Here it gives you a better picture to see how the independent hotels and the upper mid-scale and upscale are actually all seeing a lot of growth. Even though upper upscale still has the most in construction, you can see final planning for upscale and upper mid-scale have quite a few rooms, and then the independent have the most in planning.
Okay, so this is the host and profitability data for the city of Chicago. Looking at just full service hotels, we got 68 properties. About an average, there's been some growth, addition, subtraction through the market. So about an average of just shy of 29,250 rooms and just shy of 73% occupancy rates. Everything else is averaged out over a 5-year period. So as you'll see on the next slide, there's a graph. It's over a 5-year period. Average daily rate, the middle number is 180.52. Everything else is in the middle as well. This graph shows the total revenue, room revenue, non-room revenue, and total expenses and gross operating profit for the hotels in the city of Chicago. If you look closely enough at the graph, you got 65% of your revenue comes from rooms, about 35% of it is not from rooms. If you look at the total profit margin, just income to expenses, you're looking at about 42 cents on the dollar rates. And if you look at the gross operating profit, which is earnings before interest, taxes, depreciation, and amortization, you're looking at 34 cents on the dollar.
Next, we're going to look at the forecast data for the Chicago market. The 2016 forecast said that supply was 1.6, demand was 1.3, occupancy was negative 0.3%, ADR was 1.3, and RevPAR was 0.9. The 2017 forecast is all going to be positive numbers, and all greater forecast in 2016 was. Supply is going to be 2.3%, demand is 2.3% as well. Occupancy is 0.01%, which is much better than the negative 0.3% last year. And then both ADR and RevPAR are 3.1%. So now we're going to summarize everything we talked about today. So the first point is that we realized the most popular hotel, the most rooms in Chicago is owned by Hilton. And the larger of the hotel offers amenities such as convention centers, restaurants, both within the property. And the ADR percent change graph had a consistent up and down change to it, but recently it started to level out a little bit more than it had been in past years. The demand percent was at its highest in 2011, and over the years the actual supply only has a constant increase, so the supply percentage is always fluctuating. Overall, Chicago is tied with New York for the third highest in the number of rooms. And behind the room revenue, the food aspect brings in the next highest amount of revenue in Chicago. The occupancy, ADR, RevPAR, demand, and revenue has increased every year for the past 5 years from the previous year. And there have been new hotels built, but more popular is that the current hotels are consistently renovating their places for the newer, modern ways. And there's more focus on making them more luxurious. And therefore, we're seeing a big decrease in the economy class hotels.